While retail investors panic sell their Avalanche below $9, institutional capital is quietly locking up billions on the exact same network. That is a measurable, verifiable divergence. Right now, the entire crypto market looks incredibly heavy. Bitcoin is falling and altcoins are bleeding out. But when you look past the red weekly candles and examine the raw on-chain data, a very different story emerges for Avalanche. We are seeing a massive structural transition from a retail speculation token into deep-pocketed, regulated, traditional finance infrastructure. In this video, I'm going to walk you through the hard data that nobody is talking about, and then we'll jump into the weekly chart to break down a specific, long-term trade setup that has historically yielded returns of over 600%. Avalanche is currently trading between $8 and $9. If you have been watching the charts over the past few weeks, you know it has been absolutely brutal. Bitcoin is dragging the entire market down, and we are definitively seeing signs of a broader bear market environment. 7 weeks ago, price actually broke to the upside of a descending trend line, giving a lot of traders false hope. It was swiftly rejected at a key Fibonacci resistance level, and price just dumped hard. Market sentiment is completely washed out right now. Fear is dominating the timeline. But this is exactly why this video matters today. As a data-driven investor, I do not care about the emotion on social media. I care about market structure, liquidity, and risk-adjusted returns. When price action completely divorces from fundamental network growth, that creates a market inefficiency. And inefficiencies are exactly where patient capital makes money. We have to separate the short-term price volatility from the long-term network valuation. I'll show you why this current price level matters in the chart shortly. But first, the fundamental data tells us exactly who is actually buying this fear. Let us look at what the network is actually doing while the price bleeds. The total value locked for real-world assets on Avalanche just increased 68% quarter over quarter, reaching $1.3 billion. That's up 949% year over year. This growth is driven primarily by institutional tokenization and regulated financial products. This confirms institutional product market fit. Avalanche is no longer just for retail degenerate plays. It's actively absorbing traditional finance capital, and developers are making it vastly easier for that capital to flow. Avalanche recently integrated with Near Intense, which instantly captured over $45 million in cross-chain volume. There's no more bridge hopping or chain juggling. Bridging has historically been the largest friction point and security risk in decentralized finance. By using intent-based execution, they have drastically lowered the barrier to entry for external liquidity. On top of that, we have the artificial intelligence narrative. Over 1,600 autonomous AI agents utilizing the ERC 8004 standard have registered on the network. These agents are doing everything from infrastructure monitoring to extracting maximal extractable value. They don't sleep. They represent non-human power users driving persistent, organic, 24/7 transaction volume at the base layer. You might wonder if the network is decentralized enough for this kind of institutional and AI reliance. The Nakamoto Coefficient is currently sitting at 29, ranking it 4th globally for decentralization. Sophisticated investors demand this level of security before deploying multi-million-dollar capital allocations. Furthermore, developer activity remains incredibly strong. We are seeing 2,200 core GitHub code commits over the trailing 90 days. Consistent developer activity is a leading fundamental indicator that the protocol is expanding, regardless of short-term price action. This development translates directly to usage. Avalanche is currently processing transactions for 665,000 daily active users, which actually edges out the Ethereum base layer. Because of this massive usage, the network generated $7.9 million in trailing 365-day fee revenue. Here is why that matters for your portfolio. On Avalanche, 100% of transaction fees are permanently burned. Increased usage destroys supply, applying continuous structural upward pressure on the asset. Finally, on-chain data shows baseline yields reaching up to 133% for liquid staking and specific liquidity pools. These yields act as a massive liquidity magnet, inherently locking up circulating supply. Now, let us bring all of this fundamental data into the weekly chart to build our strategy. We're looking at the weekly chart. The macro trend context here is dominated by a huge falling wedge pattern, marked by those orange dotted lines, extending all the way back from the 2021 highs of $140 down to the lows around $10. Currently, price is trading below both the 21 exponential moving average, which is the red line, and the 55 exponential moving average, the purple line. That confirms the broader bearish momentum. We have immediate support down at $8.50. This level is critical because it aligns perfectly with the flush candle from October 2025, and it also matches the previous cycle low back in 2023. If we look above, we lost our last support at $11.50, turning it into resistance. Our next major resistance sits at $15, which lines up with the 236 Fibonacci level. That Fibonacci retracement is anchored from the local high of $36 in September 2025, down to the October low of $8.50. The golden pocket, the 618 level, sits way up at $25. Let us look at the oscillators. The Heikin-Ashi Relative Strength Index, down at the bottom of the chart, is reading -32, which is extremely oversold, right after a bounce from the -30 region. Notice that this indicator has also been respecting its own falling wedge structure since the beginning of 2024. Here's exactly what I wrote to my private community on Telegram yesterday. Quote, "I think AVAX is ready for a bounce. Textbook falling wedges, both in price action and Heikin-Ashi RSI. This is a long-term hold setup. I'm thinking about placing a buy limit order in the wedge support. Maybe a liquidity sweep there. I'm not counting on it though." End quote. So here's my personal long-term position strategy. I'm looking at a load zone between $10 and $7.50. I'm targeting this zone because I anticipate price might retest the support of the massive falling wedge once again. It did this exact same thing in 2021 and 2023, marked by the white circles, which led to subsequent pumps of 1,460% and 650%. For risk management, my stop loss is a weekly candle closing definitively below that falling wedge support. This setup is specifically aiming for a long-term position trade, minimum 6 months. If we close a weekly candle below the wedge, the structure is invalidated, and I'm out of my short-term trade, not my long-term bag. For take-profit targets, I'm scaling out at $15, $20, $30, $50, and $80. I'll be trimming my position the hardest at that third target of $30 because it sits very close to the macro wedge resistance. As I hit each target, I'll move my trailing stop loss up. First target hits, stop moves to average entry. Second target hits, stop moves to target 1, and so on. Right now, Avalanche represents 3% of my total crypto portfolio, with 65% still safely anchored in Bitcoin and Ethereum. When you synthesize the elite fundamental network growth with this deeply compressed technical structure, the risk-to-reward ratio becomes highly asymmetrical. The worst-case scenario is that the macro environment deteriorates further. Bitcoin continues to fall, dragging Avalanche below our absolute bottom, forcing a weekly close below the wedge. If that happens, we take a calculated loss and preserve our capital. But the best-case scenario is that the institutional capital flowing into these real-world assets acts as a fundamental floor. If this macro falling wedge plays out like the historical data suggests, we are positioning ourselves for a multi-month expansion phase. A change in the broader liquidity environment would obviously accelerate this thesis. But right now, I'm simply letting the chart dictate my entries based on established probabilities. So the on-chain data proves Avalanche is fundamentally stronger than ever, while the technical chart offers an extreme oversold entry point at historical macro support. In investing, you want to buy the deep structural fear when the underlying network math continues to grow. If you found this data-driven approach valuable, please hit the like button and subscribe to the channel. For faster, daily updates on these specific chart setups, join my free Telegram group using the link in the pinned comment below. I highly recommend you watch my last 2 videos about Avalanche to get the full historical context of this trade, and also to understand my hedge short strategy. Remember, this is my personal strategy and not financial advice. Always manage your own risk. Stay safe out there, and I will see you in the next one.